we're going to get into some of the specifics, I think, with Peter in a second, Kathleen. But just overall, in terms of what we've seen with some of the hot IPOs that are money losers, this is like another one, isn't it? I mean,
it's a bad sign. We've studied the most money-losing companies that have gone public, the most that have lost money 12 months before they've done their IPOs. WeWork'S the second most money-losing IPO after Uber. That list of companies, the 10 most money-losing, have all done very poorly for investors. We look at WeWork and we can call it WeWork, we spend. This is what WeWork is to us. And it's IPO investors are going to be very careful about valuation.
Now,
Uber's
burn
trading,
me once, right?
Uber's trading 30% below its IPO price, Lyft 25% below. You know, investors who are looking at these are going to know that that can't happen.
But they must understand that. Underwriters and the company itself must understand that they're not going to get a big...
And the latest valuation round is $47 billion. So how are they going to price this when the last private round valued the company at $47 billion? It's hard to figure out that would make any sense.
Do those dismal returns, do they change over a longer period of time as opposed to months after the IPO?
Well, still, if you start at a high value,
it's just harder.
The company takes so much time to get to that. They need to price this correctly.
So, Peter, with their business model, I mean, reading your articles, they need to make all their space like Instagram ready, right?
Yeah,
they need plants and exposed bricks and millennial like inducements and so that's expensive, right? So that's
expensive. Yeah.
There's a reason they're losing money. I mean, we understand it to build out this business, right? If it's understandable, does that make it okay?
I mean, yes, but it's a question of for how long and whether or not ultimately the returns can be earned on it. So, you know, as a reporter, I mean, I knew this IPO was coming up. I knew there was eventually going to be some sort of document out there showing some of the financials. So before that came out, I spent a lot of time talking to real estate people in New York, particularly people in the business of shared space, as it's called. And, you know, and I kind of got a sense of what I would want to see in this document. And then I looked at it, and some of it's there, to be fair, but, like, a lot of it isn't. And so that's why I wrote the piece that came out yesterday, which is, like, here's a bunch of things that you would really want to see in
Go into
WeWork'S.
some. Like, you want to know where the individual places are, not just an aggregate number.
Yeah, you don't want this big aggregate. What you want is particularly, like, there's a rival group called IWG, and each quarter or each half they put out an earnings statement. It shows you what they're making at the location level on their more mature properties versus their younger ones in Asia versus the US, you know, and it's incredibly useful detail because the older ones show you what the business can make once it's up and running. Right. And that's the big question hanging over WeWork is this all growth-related costs or can they actually make money when they're kind of all...
Because you've got 15-year leases and people are only going in for
like a little under 2. Right? Yeah.
And you also point out there's no per capita number on how many people are there.
Right.
So if people are waiting at bathrooms or elevators or crowded, can't get a private room to work in, that's...
Yeah, and you have to pay extra for the private rooms often. And, you know, like, these are things that can add up and erode the experience that people have in these spaces. They look very nice, but... the question is are they a little too crowded for people to be productive? We don't have any way of gauging that. That's the point.
And we're not even talking about any of the stuff about Mr. Newman in terms of, you know, all the
corporate governance.
Or how we're doing a slowdown.
And what happens in a slowdown when you've got 15-year leases.